In October 1907, the American financial system collapsed. Banks failed across the country. Depositors rioted in the streets. The New York Stock Exchange lost half its value in weeks. And the United States government stood by, powerless, watching the carnage unfold. Then one man stepped forward. Not the president. Not Congress. Not any elected official. A private banker. John Pierpont Morgan. And in a series of meetings that would reshape American finance forever, Morgan did what no government could do. He stopped the panic, saved the banks, and in the process proved that private bankers were more powerful than the state itself. But here's what matters right now in December 2024. The exact same setup is forming again. Corporate debt has reached $13.7 trillion, 20% higher than before the 2008 crisis. Regional banks are sitting on $650 billion in unrealized losses from bonds purchased when rates were near zero. Commercial real estate is cracking with over $1.5 trillion in loans coming due through 2025. And the smart money, the modern equivalents of J.P. Morgan, Warren Buffett with $325 billion in cash, private equity firms holding record dry powder of $2.8 trillion, are positioning for what's coming. By late 2026, based on every credit cycle pattern since 1907, we're facing a financial crisis that will make 2008 look like a practice round. This isn't history for context. This is the immediate blueprint for how you position yourself to profit while everyone else panics. Because in 1907, Morgan didn't just save the system. He used the crisis to consolidate power, acquire assets at pennies on the dollar, and set up his family's wealth for generations. And if you understand what Morgan understood, what he did, and how to replicate his strategy right now before the window closes, you can be on the right side of the greatest wealth transfer since 2008. The United States in the early 1900s had something it had never fully experienced before. Massive industrial wealth combined with zero financial regulation. After the Civil War, America had transformed from an agricultural economy into an industrial powerhouse. Railroads connected the coasts. Steel mills turned iron into empires. Oil fields made men richer than kings. And at the center of it all was Wall Street, the banks that financed everything. But this wasn't the regulated, government-backed system we have today. This was pure capitalism. No Federal Reserve. No deposit insurance. No lender of last resort. Banks were private enterprises that lived or died by their own decisions. If they made bad loans, they failed. If depositors lost confidence, they ran. And when they ran, the bank collapsed, taking depositors' money with it. This system worked until it didn't. And when it failed spectacularly. The warning signs were everywhere by 1907. Stock speculation had reached absurd levels. Trust companies, shadow banks that operated with even less regulation than regular banks, were lending recklessly. Leverage was extreme. Everyone was borrowing to buy stocks, using those stocks as collateral to borrow more. It was a pyramid built on confidence. And in October 1907, that confidence shattered. The crisis began with a scheme. Two speculators, F. Augustus Heinz and Charles W. Morse, tried to corner the market on copper. They borrowed heavily, bought up copper stocks, and planned to squeeze short sellers into bankruptcy. It failed spectacularly. When the corner collapsed, Heinz and Morse were ruined. But they weren't the only ones who lost. They had borrowed from banks, and those banks had lent deposits that weren't theirs to risk. When word spread that Heinz and Morse had defaulted, panic set in. Depositors rushed to withdraw their money from any bank connected to the speculators. The Knickerbocker Trust Company, one of New York's largest, was the first to fall. On October 22, 1907, depositors lined up outside Knickerbocker's doors. By afternoon, the line stretched for blocks. By evening, the bank had run out of cash. By the next morning, it was closed. And $62 million in deposits, gone. The panic spread like fire. If Knickerbocker could fail, any bank could fail. Depositors across New York began withdrawing. Then across the country. Banks that had been solvent days before were suddenly insolvent, not because they were badly run but because everyone was pulling their money at once. The entire financial system was on the brink of collapse. President Theodore Roosevelt was in office, a reformer, a trust buster, a man who had built his reputation fighting the power of big business. Surely he would act. He didn't, or more accurately, he couldn't. The federal government in 1907 had almost no ability to intervene in financial markets. There was no central bank. No mechanism to inject liquidity into failing institutions. The Treasury had some gold reserves but not nearly enough to stop a nationwide bank run. Roosevelt's Treasury Secretary, George Cortelyou, rushed to New York with $25 million in government deposits to prop up struggling banks. It was a gesture, a symbolic show of support. It did almost nothing. The banks kept failing. The stock market kept falling. And the government kept watching, helpless. This is the first lesson of 1907. When crisis hits, governments without the tools to intervene become irrelevant. Power flows to whoever can act. And in 1907, that was J.P. Morgan. John Pierpont Morgan was 70 years old in 1907. He had built the greatest private banking empire in American history. He had financed railroads, steel companies, entire industries. He had bailed out the U.S. government itself in 1895 when gold reserves ran dangerously low. He was not elected. He answered to no voters. But when the panic of 1907 hit, everyone turned to him because everyone knew if anyone could stop this, it was Morgan. Morgan's strategy was simple and brutal. He would decide which banks were worth saving and which would die. He would force other bankers to contribute. And he would use his own fortune as the anchor. On the night of October 23, Morgan summoned the presidents of New York's largest banks to his library. Not a request. A summons. And they came because refusing J.P. Morgan was not an option. The meeting lasted hours. Morgan sat in a chair by the fireplace, smoking cigars, while younger bankers presented balance sheets and argued over which institutions could be saved. Morgan listened. Then he decided. Trust Company of America would be saved. It was solvent, just illiquid. Morgan and the assembled bankers pooled $25 million to keep it open. Lincoln Trust would be saved but only if it merged with a stronger institution. Other banks? Let them fail. This wasn't charity. This was triage. Morgan was deciding which parts of the financial system would survive and which would be amputated. And no one, not the government, not the depositors, not even the failing banks themselves, had any say. But the most famous moment of the crisis came on November 2nd. The stock exchange was on the verge of collapse. Brokerage firms couldn't meet their obligations. If the exchange closed, the panic would become total meltdown. Morgan summoned the presidents of the major trust companies to his library. But this time he didn't just ask for cooperation. He locked the doors. Literally. The doors to Morgan's library were locked from the outside. No one was leaving until they agreed to save the exchange. Inside, Morgan's associates presented a plan. The trust companies would lend $25 million to brokerage firms to prevent collapse. But the trust company presidents resisted. They were already stretched thin. They didn't want to risk more. Morgan didn't care. He didn't ask. He told them. Sign or face the consequences. Hours passed. Midnight came and went. The bankers inside grew desperate. Some pleaded. Some threatened. Morgan sat silently, smoking, waiting. Finally, at 4:45 in the morning, they broke. One by one, the president signed. The $25 million was pledged. The exchange would open. The panic, for now, was contained. This is the moment that defined 1907. Not a law. Not a government program. One man locking other men in a room, forcing them to save the system. Private power exercised without accountability, without oversight, without democracy. And it worked. Now here's where this becomes critical for you right now. The patterns from 1907 aren't just historical curiosities. They're playing out in real time. Look at the current data. Regional banks are sitting on unrealized losses that dwarf their capital reserves. When Silicon Valley Bank failed in March 2023, it revealed that hundreds of banks had made the same mistake, loading up on long-term bonds when rates were near zero. Those bonds have lost tremendous value as rates spiked to over 5%. The FDIC estimates total unrealized losses across the banking system at $650 billion. Most banks don't have to mark these to market, so they're technically solvent on paper. But just like in 1907, if depositors start pulling money, the illusion shatters. Commercial real estate is the next shoe to drop. Office buildings are sitting 40 to 50% empty as remote work becomes permanent. Retail spaces are closing as e-commerce accelerates. Over $1.5 trillion in commercial real estate loans mature between now and 2027. Most can't be refinanced at current rates and current occupancy levels. The banks holding these loans are mostly regional and community banks, the same institutions that lack the resources to weather sustained losses. Corporate debt tells an even scarier story. Companies borrowed $13.7 trillion during the zero-interest rate era, assuming cheap money would last forever. Now those debts are coming due just as borrowing costs have tripled. Refinancing is expensive or impossible for many businesses. Bankruptcies among companies with assets over $50 million have increased 39% year over year. The credit cycle is turning, exactly as it did in 1907. Consumer debt has reached levels that would have been unthinkable a generation ago. Credit card balances hit $1.13 trillion in the third quarter of 2024. Serious delinquencies have doubled from early 2022 levels. Auto loan defaults are climbing. Student loan payments resumed after a 3-year pause, putting additional pressure on household budgets. The average American is one unexpected expense away from financial crisis, which means they're one layoff away from defaulting on everything. And here's the kicker that mirrors 1907 perfectly. The wealthy are positioning for crisis while everyone else remains oblivious. Warren Buffett hasn't just been holding cash. He's been selling. Berkshire Hathaway sold over $100 billion in stocks throughout 2024, the most aggressive selling in the company's history. His cash position of $325 billion isn't just a defensive move. It's ammunition waiting for targets. Private equity firms are sitting on $2.8 trillion in dry powder, the highest level ever recorded. They're not deploying capital into current market conditions. They're waiting for the crash. Hedge funds have built the largest short positions against regional banks since 2008. They're not betting on stability. They're betting on collapse. Central banks around the world added over 1,000 tons of gold to reserves in 2023 and are on pace to exceed that in 2024. They're preparing for currency instability that the general public doesn't see coming yet. The smart money isn't confused about what's happening. They're positioned. Based on every credit cycle pattern since 1907, we can map the timeline with disturbing precision. Right now through the second quarter of 2025, we're in the warning phase. Credit conditions continue tightening. Asset prices, particularly commercial real estate and lower-tier bonds, are under pressure. Employment still looks decent on the surface, but hiring is slowing and layoffs are increasing in sectors like technology and finance. The third quarter of 2025 through the first quarter of 2026 is when the crisis likely goes mainstream. This is when one or more significant financial institutions fail, triggering the modern equivalent of the Knickerbocker collapse. It could be a regional bank. It could be a major real estate investment trust. It could be a highly leveraged hedge fund. The specific trigger doesn't matter. What matters is that it breaks the illusion of stability and triggers withdrawals, redemptions, and margin calls across the system. The second quarter of 2026 through the end of that year is the panic and rescue phase. The Federal Reserve will cut rates aggressively and restart quantitative easing. The government will step in with emergency programs to prevent total collapse. But just like in 1907, the rescue will primarily benefit those who caused the crisis and those who positioned to profit from it. And 2027 to 2028 will be the consolidation phase where the strong acquire the weak, where assets change hands at depression prices, where the next generation of concentrated wealth is created. So what do you do? Here's exactly what JP Morgan did in 1907 and how you replicate his strategy right now. Morgan entered the crisis with enormous liquidity. While other banks had lent out every dollar they could to chase returns, Morgan had held back. He sacrificed short-term profits for long-term positioning power. Your move right now is building a 40 to 50% cash position by the third quarter of 2025. This goes against every instinct in an inflationary environment. Conventional wisdom says cash is trash, that it loses value to inflation, that you should be fully invested. That's exactly what everyone thought in 1906. Morgan knew different. Cash isn't about returns during the build-up phase. It's about optionality during the crisis phase. Put it in high-yield savings accounts currently paying over 5%. Use short-term treasury bills for additional safety. The goal isn't to beat the market. The goal is to have ammunition when the market capitulates. Morgan identified quality assets before the crisis hit. He knew which banks had good balance sheets, which railroads had valuable routes, which industries had genuine earning power beneath the speculation. When the panic drove prices down, he knew exactly what to buy. Your move right now is building your watch list. Identify 20 to 30 quality companies that will survive the crisis and thrive afterward. Focus on businesses with minimal debt, strong free cash flow, essential products or services, and global revenue diversification. Healthcare companies like United Health or Johnson & Johnson. Utilities that provide power regardless of economic conditions. Energy companies that benefit from supply constraints. Consumer staples like Procter & Gamble that maintain demand through recessions. Don't buy full positions yet. Build the list. Know the valuations. Understand the businesses. So when they go on sale, you can act decisively. Morgan used the crisis to consolidate power. He didn't just save banks. He acquired them or forced them into mergers he controlled. He turned crisis into opportunity for expansion. Your move during the crash phase is deploying capital in stages as fear escalates. Don't try to catch the falling knife. Don't try to time the exact bottom. Use a systematic approach. When the market is down 20% from peaks, deploy 10% of your cash. Down 30%, deploy another 15%. Down 40%, deploy another 15%. This ensures you're buying progressively cheaper while maintaining reserves in case the decline goes further. Morgan forced other wealthy individuals to contribute to the rescue. He didn't save the system alone. He used his credibility and power to extract capital from others. Your equivalent is understanding that during the crisis, credit becomes impossible for most people. Home equity lines get frozen. Credit card limits get cut. Margin accounts get called. The ability to borrow to buy assets evaporates exactly when assets are cheapest. That's why building cash before the crisis is non-negotiable. Morgan emerged from 1907 more powerful than before. He acquired Tennessee Coal, Iron, and Railroad Company at a fire sale price, adding it to U.S. Steel's empire. He consolidated his control over New York banking. He proved that private financial power could supersede government authority. Your goal isn't just surviving the crisis. It's using it to fundamentally improve your financial position. The assets you buy during the panic should generate income and appreciation for decades. Here are the specific signals to watch that will tell you exactly where we are in the timeline. Signal 1 is the KBW Regional Banking Index. This tracks mid-sized banks, the modern equivalent of the trust companies that failed in 1907. It's currently around 90. When it breaks below 70, it means the market is pricing in serious distress. Start moving to higher cash allocation. Signal 2 is the credit spreads between junk bonds and treasuries. Currently around 400 basis points. When they widen beyond 600 basis points, it means credit markets are freezing. This precedes the crisis going mainstream by 30 to 60 days. Finalize your watch list and prepare to deploy. Signal 3 is the VIX Volatility Index. Currently in the low teens. When it spikes above 40 and stays there for more than a few days, panic has arrived. This is when you begin deploying cash. Signal 4 is the federal funds rate. Currently at 5.5%. When the Fed makes an emergency unscheduled rate cut of 50 basis points or more, they're acknowledging crisis conditions. Deploy aggressively. Signal 5 is the number of bank failures reported by the FDIC. In 2024, 5 banks failed. When that number accelerates to 2 or 3 per month, the cascade is underway. Maximum deployment mode. Track these 5 signals weekly. Create a simple spreadsheet. Watch for the progression. The signals won't all flash at once. They'll cascade over months, giving you time to position and reposition. Your 90-day action plan starting right now must be specific and measurable. In the next 30 days through January 2025, open a high-yield savings account if you don't have one. Transfer funds to reach 20% cash allocation. Begin building your watch list of 20 to 30 quality companies. Research their debt levels, free cash flow, and business models. Set up tracking for the 5 crisis signals. Create alerts so you're notified when thresholds are crossed. In the 60-day window through February 2025, increase cash allocation to 30%. This means selling some current holdings. Yes, this might mean taking profits or small losses on positions. That's fine. You're trading short-term optimization for crisis preparedness. Finalize your watch list. Know the companies intimately. Understand what price levels represent genuine value. Set up a separate brokerage account if needed to keep crisis deployment funds separate from long-term holdings. In the 90-day window through March 2025, reach 40% cash allocation. Begin tracking the 5 signals daily instead of weekly. Run scenarios for how much capital you'll deploy at various market decline levels. Make sure you have instant access to funds so you're not stuck waiting for transfers when opportunities appear. Review and rebalance monthly as we move through 2025. The panic of 1907 wasn't solved by government intervention. It was solved by one man with capital, credibility, and the willingness to act when everyone else was paralyzed. Morgan didn't just preserve his wealth through the crisis. He multiplied it by being the buyer when everyone else was a forced seller. The same dynamic plays out in every financial crisis. The 2008 financial meltdown created buying opportunities that generated returns most people thought were impossible. Warren Buffett deployed $5 billion into Goldman Sachs in September 2008 at the height of panic. That investment made over $3 billion in profit. He put $5 billion into Bank of America in 2011 when fear was still elevated. That stake is worth over $40 billion today. Those aren't luck. Those are the returns available to capital deployed during crisis when everyone else is too scared to act. But here's what most people miss. Buffett didn't get those opportunities because he was smarter than everyone else. He got them because he had capital when capital was scarce. He had positioned years earlier by holding cash and short-term instruments instead of reaching for yield. When the crisis hit, he wasn't scrambling for liquidity. He was offering it at terms that reflected the desperation of the moment. That's the Morgan playbook. That's what you're replicating. Right now in December 2024, conventional wisdom says you should be fully invested. The market is hitting new highs. Technology stocks are soaring on artificial intelligence hype. Why would you hold cash earning 5% when you could be making double-digit returns in stocks? Because the setup today is identical to early 1907. Asset prices disconnected from fundamentals. Credit conditions tightening beneath the surface. Warning signals flashing for those paying attention. And smart money accumulating dry powder. Morgan understood something that most people never grasp. Crashes aren't random events that appear from nowhere. They're the inevitable result of excessive leverage meeting tightening credit. They're predictable in pattern even if the exact timing is unknowable. And they represent the greatest wealth transfer opportunities in capitalism because assets don't become worthless during crashes. They just change hands from weak holders to strong holders at prices that reflect panic rather than value. The government response to 1907 was telling. Instead of trying to prevent future crises by regulating speculation or limiting leverage, they created the Federal Reserve in 1913. An institution that was supposed to be a lender of last resort so that future panics wouldn't require J.P. Morgan to personally save the system. But here's what actually happened. The Fed didn't reduce the power of people like Morgan. It institutionalized it. It gave the largest banks a government-backed lender to bail them out when their bets went wrong. The 1907 panic didn't end banker power. It made it permanent. The proof is in how 2008 played out. When the housing bubble burst and financial institutions failed, who got rescued? The largest banks. Who got their executives prosecuted? Nobody. Who profited from the rescue? The same institutions that caused the crisis. J.P. Morgan Chase acquired Bear Stearns and Washington Mutual at fire sale prices, emerging from the crisis more powerful than before. Bank of America bought Merrill Lynch. Wells Fargo acquired Wachovia. The crisis consolidated banking power into fewer, larger institutions, exactly as Morgan had consolidated power in 1907. And who paid for the rescues? Taxpayers through the bailouts, savers through zero interest rates, workers through a decade of weak wage growth and reduced economic opportunity. The pattern is consistent across every crisis. The system is designed to protect itself and those who control it. When crisis hits, interventions benefit the interveners, not the victims. Understanding this isn't cynicism. It's realism. And it's the knowledge that lets you position correctly. You're not going to change the system. You're not going to make it fair. What you can do is position yourself on the right side of the wealth transfer. By holding capital during the build-up, deploying during the panic, and benefiting during the recovery. The timeline is accelerating. The commercial real estate loans maturing through 2025 and 2026 will force repricing of assets that have been artificially supported. The regional banks holding those loans lack the capital cushions to absorb significant losses. The corporate debt refinancing wave will force companies to either pay much higher interest rates or default. Consumer credit is maxed out with no more capacity to sustain spending growth. Employment still looks stable on the surface, but leading indicators are deteriorating. Job openings are falling. Hiring rates are slowing. Hours worked are declining. Companies are cutting costs through attrition and efficiency rather than layoffs that make headlines. But the result is the same. Less income growth, less spending, less economic momentum. The Federal Reserve is trapped between inflation that won't die and an economy that can't handle sustained high rates. They'll hold rates high until something breaks, then they'll cut aggressively. But the cutting will come after the crisis is already underway, just as interventions in 1907 came after banks had already failed. By then, the wealth transfer will be in motion. Those with capital will be buying assets from those forced to sell. Those who prepared will be profiting while those who ignored the warnings will be trying to preserve what's left. In October 1907, J.P. Morgan made decisions that shaped American finance for the next century. He chose which banks lived and which died. He forced other wealthy men to contribute capital on his terms. He acquired valuable assets at depression prices. And he proved that private financial power could supersede democratic government when crisis hit. Right now, you're watching the same patterns form. Excessive leverage. Tightening credit. Asset prices disconnected from fundamentals. Warning signals flashing. Smart money positioning for what's coming. The timeline is clear. 2025 is your positioning year. Build the 40 to 50% cash allocation. Finalize your quality watch list. Track the 5 crisis signals religiously. 2026 is the crisis year when unemployment rises, markets correct, credit freezes, and panic creates once-in-a-decade buying opportunities. Deploy capital systematically as fear escalates. Don't try to time perfection. Use the Morgan strategy of being the buyer when everyone else is a forced seller. 2027 and beyond is the consolidation phase when your positions bought during panic generate returns that seem impossible during normal times. When your discipline and preparation compound into wealth that reshapes your entire financial trajectory. J.P. Morgan didn't get lucky in 1907. He positioned before the crisis, acted during the panic, and profited for decades afterward. Warren Buffett didn't get lucky in 2008. He held cash when everyone else was reaching for yield, deployed when everyone else was paralyzed by fear, and multiplied his capital while the market collapsed around him. The playbook hasn't changed because human nature hasn't changed. Greed drives leverage during good times. Fear drives panic selling during crashes. And wealth transfers from those who don't understand the pattern to those who do. History doesn't repeat, but if you ignore it, it will crush you all the same. The difference this time is you know exactly what's coming. You know the signals to watch. You know the strategy to execute. You know the timeline. Morgan locked bankers in his library and forced them to save the system while profiting from the crisis. You don't need to lock anyone in a room. You just need to do what Morgan did. Build cash, wait for panic, buy quality assets from forced sellers, and hold through the recovery. The 1907 crisis made Morgan's power permanent. The coming crisis will determine whether you position yourself on the right side of history or pay the price for ignoring it. The clock is ticking. Will you be ready? If this gave you the exact playbook to position like Morgan before the 2026 crisis hits, hit subscribe. The crash is coming. The only question is whether you'll profit from it or be destroyed by it.